Silver smashes $82. COMEX vaults draining. Shorts trapped. Banks under pressure. Right now, as you're watching this video, your financial future could be hanging by a thread because of what just happened in the silver market. And if you own any precious metals, if you're considering buying silver, or if you simply want to understand how the financial system actually works, you absolutely cannot miss what's about to be revealed in this video. This is not speculation. This is not empty propaganda. And this is certainly not sensational content designed to scare you into making the wrong decisions. Everything you're about to hear is verified information, backed by real data that you can look up yourself. What just happened to the price of silver when it broke through and crushed the $82 level is not the end of the story. It may be the beginning of something much bigger. Let's look back for a moment. Not long ago, the silver market went through one of the most brutal intraday collapses when the price was slammed from $87.50 straight down to $75.80 in under 90 minutes. At that time, a wave of automated sell orders created a liquidity fracture, wiping out billions of dollars in notional value and sending countless retail investors into panic. Traders in the derivatives market who were using borrowed money were liquidated mercilessly. But today, the script has completely flipped. Silver has just officially broken above $82 in a violent move, and this time it's the shorts, the ones who borrowed millions of ounces of silver on paper to push the price down, who are now totally trapped. When the silver price broke through the psychological resistance level of $80 and drove straight into $82, it triggered the opposite kind of chain reaction. Short sellers are now desperately trying to buy back contracts to cut their losses, but they're facing a brutal reality. Nobody wants to sell to them at cheap prices anymore. Automated trading algorithms, which were previously programmed to dump when price fell below $80, are now scrambling to execute buy orders. A severe shortage of real sell orders has created a liquidity vacuum, pushing the price vertically in one direction. But why is nobody willing to sell? Why are the shorts panicking so hard? The answer lies in the real vaults of COMEX and the London Bullion Market Association, LBMA. The latest data shows that registered inventory levels at major exchanges, including COMEX, have declined significantly in recent years. The fact that this inventory keeps draining despite price volatility shows that metal is leaving these facilities because of real end-use demand, not because of portfolio rebalancing. This is the sign of a physically tightening market, one where vaults are being steadily depleted to satisfy industry's hunger. The disconnect between paper pricing and physical scarcity is reaching a breaking point. You need to understand that most futures contracts are cash settled rather than delivered through physical metal. This paper market has ballooned to many times the size of the underlying physical market, creating massive potential mispricing. But futures contracts cannot remain disconnected from physical reality forever, because ultimately those contracts must reference real metal that exists somewhere. And the reality is that metal is disappearing from the vaults. This pressure isn't just weighing on small retail speculators. It's weighing on massive financial institutions, and the big banks have begun to smell this structural shift. To understand the math behind this breakout, we have to bring up a report called the Price Fracture Report, released by Bank of America. That report sent shockwaves through Wall Street. Michael Whitmer, head of metals research at Bank of America, went far beyond typical cautious price targets. In an extremely detailed report, he argues that silver is going through a structural revaluation. This isn't speculation. It's a mathematical inevitability rooted in market history. And the report suggests silver is positioned for a price surge that could take it to $135 to $309 per ounce. Why such an unbelievable number? The driver isn't some new giant mine discovery. It's a deep analysis of the gold-to-silver ratio. This ratio is one of the oldest and most reliable indicators in financial history, showing exactly how many ounces of silver it takes to buy 1 ounce of gold. Bank of America points out that when the ratio sits at 59-1, it behaves like a compressed spring wound too tight. Whitmer notes that in the last major silver spike in 2011, the ratio was compressed down to just 32-1. If the market simply repeats that mechanical move today, with gold holding its current value, silver would immediately be repriced at $135 per ounce. But the report goes further into what they call a black swan target. Looking back at the historic frenzy of 1980, during a period of severe inflation and currency debasement, the gold-to-silver ratio collapsed all the way to 14-1. Bank of America's analysts ran the numbers and concluded that if a similar compression happens in today's financial environment, silver would reach $309 per ounce. That $309 figure isn't a lucky lottery ticket. It's the outcome of mean reversion that markets have displayed many times over the past century. When the ratio is at 59-1, it implies that silver's industrial and monetary value is being ignored by the market. And history shows that when that neglect disappears, the adjustment is extremely violent and fast, often within months, not years. Today's break above $82 may only be a temporary stop before the ratio begins a sharp collapse. But the craziest part of the story, the part that's making banks sweat and hedge funds panic, lies in the liquidity gap. Bank of America highlighted a staggering fact. The professional investment world is dangerously underallocated to precious metals. The data reveals that wealthy entities and funds currently hold only 0.5% of their total assets in gold and silver. Think about that number, 0.5%. Meanwhile, Michael Whitmer's team at Bank of America ran portfolio optimization models and suggested that a fully optimized portfolio built to withstand today's inflation and currency risks should allocate 20% to 30% to gold and silver. The gap between the current 0.5% and the suggested 20% allocation represents trillions of dollars in potential capital flows. This is the wall of money waiting on the sidelines to enter a physical market that is already extremely small. It counts if professional managers decide to rotate even a small portion of assets to match Bank of America's recommendation. The impact would be like an earthquake. Even a shift from 0.5% to 1% would double demand for investment bullion overnight. And this is the core issue the shorts are now realizing. There simply isn't enough physical metal in existence to satisfy a large-scale rotation like that. The silver market is famously tight and illiquid compared to bonds or equities, which means big buy orders can drive price exponentially. When massive flows try to squeeze through a doorway that's only wide enough for a few million ounces, a bottleneck forms. And that bottleneck is where the price explosion happens. The push above $82 was largely driven by retail and early adopters. The real giants haven't even stepped into the arena yet. When they do, they don't buy a few coins. They buy entire vaults and future production capacity from mines. A silver breaking above $82 today is the bell signaling that this shift has begun. Moreover, the third pillar, and perhaps the most important one, behind this powerful breakout is the physical reality beneath the ground. Bank of America emphasizes that we are now in the fifth straight year of a structural deficit in the global silver market. This isn't a temporary supply chain disruption. It's a deep geological and industrial shortage that has been forming for half a decade. The mining industry is in crisis. The report notes that production from the 13 largest gold and silver mining companies in North America is expected to fall by 2%. That contradicts the basic economic principle that higher prices lead to higher supply. The reason is exploding mining costs, known as all-in sustaining costs, AISC. Energy costs from diesel, wages for skilled labor, and equipment prices are all soaring. We've reached what analysts call peak silver, where humanity is using more metal than we can pull out of the ground. Mines are getting deeper, ore grades are getting lower, and regulations are getting tighter. Miners simply cannot sell their metal cheaply when it takes record levels of capital to produce an ounce of silver. That creates a hard floor under the silver price. At the same time, scarce supply is colliding with an unprecedented boom in industrial demand. The solar industry has become one of the largest consumers of silver on the planet, with every gigawatt of installed photovoltaic capacity requiring about 1 million ounces of this metal. Electric vehicle production continues to accelerate globally, and each EV contains significantly more silver than a traditional internal combustion car. The build-out of 5G wireless infrastructure remains intense, creating steady demand for silver in electronics components and connected devices. Even medical technology applications and water filtration systems are using silver's unique antibacterial properties. Every smartphone, computer, An electronic device contains small amounts of silver that cannot be economically recovered once the device is discarded. Every ounce of silver used in these industrial applications effectively disappears forever, consumed in manufacturing processes that don't allow economical recovery. This is completely different from investment silver, which can return to the market when investors sell. Combine a 5-year deficit with a 2% production decline and non-elastic industrial demand. There is no giant new silver mine ready to come online and rescue the market. It takes 10 to 15 years to discover a deposit, secure permits, and build the necessary infrastructure. That means even if silver hits $309 tomorrow, no flood of new silver will immediately pour into the market. The physical shortage is absolute. So today's $82 level is supported by real mining costs and relentless industrial consumption. Breaking through this resistance is sending a clear message to anyone still trapped in the illusion of fiat currency. The era of cheap silver is over, and the era of structural revaluation has officially begun. For individual investors, understanding these market structure issues can help you make better decisions. The most important lesson is to avoid excessive leverage. As we've seen in the past, leveraged positions in a highly volatile market always carry risks that can quickly overwhelm even the most carefully researched investment thesis. People who buy physical silver with their own money, without leverage, always keep their metal through temporary paper price swings. Owning physical metal provides a psychological security that leveraged positions can never deliver. Time is often on the side of the physical metal holder, while time can be the enemy of the leveraged speculator. That asymmetry is your compass. COMEX vaults keep draining, derivatives algorithms are being forced to flip direction, and massive institutional capital is slowly waking up from its indifference. You're witnessing not just a price rally, but a shakeout of weak hands, a liquidation of leveraged speculators, and a cleansing of the excesses built into the market. What remains is a smaller but more committed group of investors who understand the underlying thesis and are willing to hold through adversity. These are the people who ultimately get rewarded when the physical supply deficit finally forces price to establish a new order. Silver has served humanity as both money and an industrial input for thousands of years, and that dual role gives it a unique value in the modern world. Physical silver remains a tangible asset that cannot be printed, cannot be digitally confiscated, and does not depend on any counterparty to hold its value. In a world where national debt has surpassed every imaginable level and central banks continue to expand the money supply, tangible assets like silver become the necessary anchor for a stable portfolio. Let knowledge of this market empower you to act with confidence instead of reacting emotionally. Don't let fear steal your opportunity. Today's break above $82 is the strongest confirmation yet of physical reality pushing back against manipulation in the paper market. Be patient, stay away from leverage, and recognize that real wealth lies in the weight of the metal you can hold in your hand. Thank you for watching. Don't forget to check the data sources below in the description. Do your own research and prepare for the historic wealth transfer unfolding right in front of us. See you in the next video.